Hey folks, and welcome to the Pipnotic Symposium for the 11th of September 2019. My apologies for not getting videos out last week. I think I maybe did one, but I was occupied with committing the latest stable update to the Pipnotic software. And so my apologies for not getting it out, and we will continue videos from this week. And so we have a price chart here. This is the Euro American dollar. And as traders, we're looking to trade at prices of value. When you see price moving up and down like this, it can be a little bit maybe complex when trying to assess where we should be buying and selling. Essentially, we should be buying at low prices and selling at high prices. And one way that we can help us assess where we have high value and where we have low value is using trend lines. Okay, and I'll refer this as market structure. So we try to specify a framework for an asset by using trend lines. And what we like to do is we like to use very clear swing points for this. So we have a clear swing point here. We have one here. I'm just going to do these very quickly. And the reason these are clear is because these are happening at the extremes. So this is the highest high for a long period of time. This is the lowest low for a long period of time. Another one, another high, another low, another high, another low, another high. And the reason these are interesting to us is because when price was down here, we came down, we retreated, we went high. When we came up here, we retreated, we went lower, we went higher, we went lower, we went higher, we went lower, and we went higher. Okay, and so notice we're starting to see a bit of a pattern. Okay, we have the major swings from here down to here and so on, all the way down to where current price is. But notice that within these, we're also seeing the same thing. So we're having micro lows here, a micro high here, micro low, micro high, all the way through here. And so this is essentially telling us something that is very interesting, which is related to chaos theory, and that is that price is fractal. Okay, so you have price moving up, down, but within this, between this low and this high and this high and this low, we have similar patterns like look like this. Okay, and so on and so forth. And within this one here, we have similar patterns. Okay, and this is just telling us something that's really important, and that is, where are the major turning points happening? Are they happening at these micro swings, or are they happening at these macro swings? This is really important. And notice that they are happening at the macro swings. When price came up here, we went down. When price came down here, we went up. We came up here, we went down. Okay, and so this is telling us that we have to focus on the higher time frames in order to identify where the major flows are occurring. Okay, and you can't see that when you're looking on a 1 minute or a 5 minute chart, but what you can do is you can notice where these are happening when you're looking at the daily, the weekly, and the monthly. So even though you are trading perhaps on the 5 minute, the 15 minute, the 1 minute, whatever, some smaller time frame, you always need to be mindful about what's going on in the bigger time frames, because this is going to be showing you where the major flows are moving. And this is interesting because we know that if price moves up to this area here, we know that we are likely going to be moving away. We have these other highs here, and these little highs here, which are essentially the little ones within this move here. These are telling us where we have the beginning of the buys and the sell zones, which is super important to us. Okay, so what we need to do when we're looking at a price chart like this, we are on the daily chart. We'll notice that we can use these highs and these lows, and we can define a structure of price. So we have a trend line. We connect the two most recent major highs and major lows. Two most recent, we got something like that. Notice the price is just moving lower. What does that tell us? Well, that tells us that we have a state, we have a kind of a window of value here. When price moves to the upper edge of this area of value around here, it seems to move lower. And when price moves to the upper edge of this area of value, it seems to move higher. Okay, so this is really important to us to know, because it enables us to define windows where price is likely to move. And so when price moves down, when price moves up to this area of supply value, it's probably going to drift a little bit lower. when it moves down to this one here, is probably going to drift a little bit higher. And how do we know that? Well, we know that because price has done this historically. And so price is telling us where we are able to entice buyers and sellers to engage in the market. What's going on in here is this is liquidity being distributed, okay, both to sellers and to buyers. But the major buying and the major selling are happening at the extremes. This is not the extreme, this is the mean. Okay, so we have a mean here. This is the middle of the mean, roughly. We can probably make it fit a little bit better if we do something like this. Okay, something like that. Doesn't have to be perfect, just kind of a rough. We have something like that, okay? That's kind of the average price for this channel of value. Price moves up here, it moves down. When it moves down here, it moves up. Okay, so if you know this, you can do the same thing on other time frames, the bigger time frames or the smaller time frames. But let's say that we are intraday traders. So we're in and out of the market typically within a day or two. Okay, so we have this here. And so now we can go to the smaller time frames, let's say the 1 hour chart, and we can look for when price begins to enter these windows of opportunity. And you can't really see those now, but what you can do is you can line up these areas of supply and demand with areas where we could expect price to bounce in the future. And notice that we have something that looks like this. Let's update the line like that. Let's say it looks something like that. It's at the mean of this area of low value. And if we want to go to the upside here, we can do the same thing here. So we'll just connect. Oops, wrong trend line. Sloped. We just connect something like that. Okay, so we do the same thing. We zoom out. We can see that this is probably where we're going to have a bit of a reaction in price. And so what you want to do now is we've marked off the high prices. This is a high price for the Euro American dollar, and these are low prices. So this is a discount price for this asset, and this is a high price for the asset. Okay, so what we're doing is we're waiting for price to move into this area of value that is historically shown to attract selling pressure. So we're going to wait for price to enter here, or we're going to wait for price to enter here, which is historically a price that has been low enough to attract buyers. And so we wait for this to happen, wait for price to move into these little zones. And when they get there, then we're essentially lining up areas of supply and demand that reside within this area. Right now, we can't really see what's going on here, but price will probably move down into this price window. This is a window of opportunity, and it will start to form patterns once it does that. And the patterns that you'll see once price moves into this area here or into this area here are going to tell a very clear picture, because what they'll do is you'll see price, let's say price moves up into this window, it'll move up, and then it'll move down because we've attracted the first sellers. And then it'll typically move a little bit higher to advertise an even more attractive price, and then it'll move lower. And then because we have then supply that has been established, been put into the market, it'll probably advertise a nice area of supply within this range here that we're seeing. Okay, so then price will typically poke into this area, and then this is where the turnaround will happen, and then price will typically continue down to the opposing side of the market structure. Okay, so we're not simply just selling and buying at these trend lines. We're waiting for price to enter them and then show us clearly that is likely to turn around, because you don't know what's going to happen. Price could enter this area of supply value and continue moving higher and never look back. You don't really know what's going on. And this is because we have found a really nice piece of graphic here which I like, and this says here what's driving currency prices. We have supply and demand, we have changes in interest rates, we have inflation, deflation, political stability, market sentiment, and news releases. Supply and demand are in the market. Changes in the interest rates, these are slow. Inflation is slow. So these are the slower ones. And then you have news releases, which are faster, market sentiment, which are faster. Okay, so how do you incorporate all of these into a trading chart. And what you do is you focus on the bleeding edge price, which is to the right side of this, and you combine it with what you can see on the left side of the chart here, which are typically like the longer term patterns that you see on a chart. Okay, and so you'll see this is sentiment driven, and these major flows here, this is supply and demand. Here we have demand down here and we have supply up here. Okay, this is sentiment driven, so you need to be a little bit mindful of this. And so focusing on minor supply and demand that is old historically is likely going to get you into trouble. Why? Because the sentiment has changed. Okay, so you have to combine the two, and you can do this by marking off areas of supply and demand, marking off areas of perceived value on the chart like this. Okay, so if we focus on supply and demand, because this is our favorite tool, you can see here that down here we had this area of perceived value. Price poked into it, we poked a little bit deeper into it, and then we left. Remember, this was the pattern that we spoke about just a second ago, where we had a high price advertises a slightly higher price, and then it leaves. The same happens in demand. Price moves into an area of demand, we advertise a slightly cheaper price, and then price leaves. That's what we're seeing just here. So you often see this. You can see them on this chart, which is a weekly chart, but you can also see them on the smaller time frames, such as the 1 minute chart. And we'll have a look at the 1 minute chart, see if we can find those, where we have a high price, we start to advertise an even higher price, and then price turns around. And so what you want to look for is you want to look for these. I'll refer them as the beginning of the buy and the beginning of the sell zone. And you can see this by looking at patterns. We have a historical high, and we had pullbacks to these highs or pullbacks to these lows, and then a departure. Okay, so first of all, you have to identify where these highs are. And here we have a high. Let's just mark off this one here. Okay, so we have this area here, and notice that we have these pullbacks. We have this pullback here, and price comes up, and then it leaves. These are really important to us because they are telling us where we have expected selling pressure. So we had this, oops, wrong thing. We had expected sellers at this level here. Why here? Because we're advertising these higher prices. Price pulled back, we have these big wicks, and then price left. Okay, so you can expect price to react at this point in the future. What happens then? Well, now we have, once prices retrace to these prices, it's been rebalanced. Then you have to look to the higher ones. We have this one here. We can expect price to move back up to this high and then leave and turn around. Once prices return to it like it has here, we have to look higher. We can find these by looking for the wicks, these attempts to move up into the supply and then departure. And we have that here. Where's the highest wick? You can see the highest wick is just here. Price pokes up into the area, and then we leave. And this is happening within the meat of this area of supply. And if you want to get complex and into some more detail, then you can go to the smaller time frames and look for these buy and sell zones. And you can notice here that we had price moved higher, we moved a little bit lower, and then we left. So you could probably move it up to here, because this is that attempt to advertise a slightly higher price and then a departure. If we go back to where price tested it, it's probably pretty close. Can't see here. Probably pretty close to where price returned to. That was the wrong price nodule. Let's go. Okay, here. So here it is. We had this one here. Price came up to these highs. You see price left, a high, a high. This is telling us this is where the beginning of the sell zone is. Now we move back. Okay, here it is. And this is price reacting at that level. So what we're doing is we're looking for major turning points in the market. This is a major turning point because price came up to it and we moved and we left. So what we're doing is we're looking for these patterns again later on in the future. And we've done that, and this is where price returned to. And it looks like magic because it's so precise, but it's not magic at all. It's simply the way the market works. Okay, so if we have a look at this one here, I mean, price came to this area and then we left. But notice that we had a pullback. We had an attempt to move prices higher, at this price level just here. Okay, price came to this level and then we left. And so now we have to look for the beginning of the sell zones. And notice here that we actually had price pull back to here. Okay, so this is actually the beginning of the sell zone on this specific time frame. Price is down here. It'll likely wriggle up to this level, have a bounce, and then it'll move a little bit higher, probably up to this area here, the upper edge of this area here, and move lower. And notice here we have a pullback, retreat, pullback, retreat. So this is going to be probably the next level that price is going to reference in an attempt to advertise these good prices where we can expect to attract or onboard some selling pressure. And this is what we can see just here. And so these little wicks are essentially arrows telling us where we need to be getting involved in the market. If you go to the 4-hour chart, you can see these all over the place. Okay, so we had this one here. Price came up, we pulled back, then we left. What does that mean? Well, that means that the buy zone for the euro US dollar on the 4-hour chart starts here at the 10990 level. Okay, so this is price left, the slingshots pull back, we're advertising a nice price, and then we leave. And the same thing is happening here. Price established this area of supply, we left, we pull back. So when price had left here, we had this as the reference point. Okay, price came back to it, poked into it. Next time you go a little bit deeper, you go to the new established sell zone. This is where price went to, and when this happens, then you move it higher. So this is a new sell zone. Okay, and this is in the middle of this area of 4-hour supply, and price didn't manage to get back up there again. This is where we managed to find enough sellers to draw price lower. And you have the same thing happening here. Okay, where we have an area of supply that was established here. We know this is supply because when price left this area of supply, we managed to compromise this area of demand. So we had demand. We know it's demand because we managed to remove historical supply, but also price reacted here. And so we know this is an attractive price to buy at because price tested it, and now it's gone. And the origin of the move that cut through this is this one here. Okay, the beginning of the sell zone is here. So price will probably go down, do something, then it'll come back, it'll poke into this area, maybe go through it and move down. Then it'll go a little bit deeper and go down, and then eventually it'll arrive at this area of supply, and this is where the turnaround will typically occur. Okay, and notice if we go to our graphic, this is supply and demand. We have changes in interest rates. Interest rates specify or help determine the interest rate differential between the two currencies, the euro and the USD. The euro has negative interest rates. The American still has slightly high interest rates, and so buying would be expensive because you're going to be paying interest, but selling will be paying interest, and so the major flows are going to be short. Okay, for this currency, they're not going to be buying the euro US dollar because it's going to be expensive to hold the position overnight. So if you're trading 1,000 lots of the euro US dollar and you are buying it, for each one lot you're going to be paying just over $11 per standard lot per day. That's a lot of money. That's an enormous amount of money. And so the smart money is going to be selling the euro USD, and they are going to be earning about $6 per day per standard lot. So $6 per standard lot. If you have 1,000, that's $6,000 a day, okay, to hold this position short. And so the smart money is going to be selling, unless the settlements are going to be within a very short period of time. But the major flows, the major banks who are positioning themselves based on inflation and interest rates, I mean, they're going to be holding these positions for much longer periods of time, in contrast to intraday guys who are trading the news. They're looking at market sentiment and stuff like that. Okay, so you have to be paying attention to this stuff. But for guys who are trading intraday, they don't maybe care so much about this because their positions are settled before the clocks past midnight. Okay, so super interesting, very important information to pay attention to. Okay, so if we have a look We'll have a look at this one here. This is a Euro USD. Let's have a look at where we can expect price to have a bit of a bounce. Keep in mind, if we're going to be holding this position for long periods of time, I mean, short is obviously the way to go. But notice that price is pretty low, isn't it? And so selling now would be selling at a really cheap price. Ideally, we want to be selling high and buying low. And so prices, we reacted this area of weekly demand. We established this child demand just below price. See this box here? And this is child demand because we had this area here which was tested once. Now prices moved through it, and now we're moving down. So this is qualified as being valid demand because it consumed this supply. And so now we can expect buyers to potentially re-enter the market at this price point here, roughly. But notice here that if we consider what we looked at previously, here we have a major buy zone, but we need to position ourselves at a beneficial price. And notice, since this low was established, this is the all-time low for the time frame that we were looking at. It's the all-time low. Where do the pullbacks come back to? Start here and look at these slingshots. Here we have one. This is a pullback. Okay, this is a pullback. Price came to this area was established. Price went higher. We pulled slingshot back and then we left. And now we're coming down and we're trying to get to it again. And so we have a few pullbacks. First we had this one. Price came close to it. We touched it here. We left. Now we're going a little bit deeper, and now we're going deeper still. So that brings our attention to this one. So this is probably where we're going to have a new bounce. And then below that, the update, we have this one here. We had this one that was established. Price went away. We poked. We went a little bit deeper. Then we left. We formed a new buy zone. We left. We formed demand. A new buy zone. Price left. We tested the edge of the buy zone. We went through it. We tested this one here, this micro buy zone, and then the buy zone for the 4-hour chart is just here. So we have weekly demand here. The beginning of the buy zone is towards the bottom, and so we'll mark that off like so. We'll do about 2 times the size. Matter of fact, I'm going to save a template, so a profile. This is going to be called markets.com, like so. Okay, find markets.com, whatever, and we have that. Okay, so we're going to leave these on there. We're going to see what happens. Let's have a look at the dollar, Japanese yen. Where are we? Well, we're moving. We went to the beginning of this sell zone here. We went into it. Here we have supply. We have a new sell zone here. Just here. So we went to the sell zone. What does that mean? That means intraday we're going to be moving lower. If you go to the 4-hour chart and you have a look, we're looking to move lower. We came here. We tested it. And this is the one that we saw here. This is it. We'll mark off the high. Confirm. Yeah, that's the one. We went deeper. We turned around. So now we mark this one off and we look left. Where do we have the next one? We have the next one here. This is where price pulled back to. This is the area of supply. So this is the beginning of the sell zone for this price structure just here. We have, once that is rebounced, here we have the new one. And if you look up here, we don't really have any clear. Okay, on the daily chart we have clear supply. So price rallied, we moved sideways, and we left. We pulled the slingshot back, and then we departed. Pulled the slingshot back, and we departed. So this one has been rebalanced. This one is yet to be rebalanced, and this is the origin of the move that managed to move away. Okay, so we'll leave that one on there, and we'll see what happens as well. Because these are super interesting. You have to find supply on a major time frame, and then you have to look within that major time frame, and you have to identify the beginning of the sell or buy zone within that area of supply and demand. You mark it off with your line. You identify the micro supply that is within that higher time frame supply and demand. then you put your entries at these edges of the buy and the sell zone. Okay, so that's the edge of the buy or the sell zone is an aggressive price, and the actual supply or demand that is formed within that higher time frame supply and demand, this is the more conservative approach. Okay, and then you have something called a deep zone, and the deep zone is kind of beyond an area of supply or demand. So we have this area here, price moved higher, we moved sideways, and then we left. The deep zone would be where this blue line is, because this is absolute fresh liquidity above. So the beginning of the sell zone starts at this area of supply and it continues higher. Okay, so this is a really conservative entry here, because last time price came up to this area, we left. We came to the area, the edge of it, we left. Okay, and so price is returning to these highs, which are typically going to be the deep zones on higher time frames, or small time frames, and they're going to be the beginning of the sell and buy zones on the higher time frames. I hope that was clear. It's kind of maybe a complex explanation. Cool. I know it's a lot of information to digest, so I'll leave it at just under 30 minutes. If you have any questions, please send them in, and I will see you in the next video. Thanks for watching.